G'day traders, Stacey Burke from Stacey Burke Trading. Today we're going to be looking at some end-of-day charts, and we're going to be looking at just using price action and looking to see where traders are brought into trades either on a breakout or on a follow-through trade, and where traders can get trapped and where you can look for obvious areas where traders are trapped and there's an opportunity for you to enter the market with a low risk, high reward opportunity. So we're just looking at an end of day chart here with the Euro USD. No particular month or anything like that. We're just scrolling through. But we're looking at, I'll just flip through, and I encourage you to print off your own charts and go through and do this for yourself, because it's an exercise that I think will start to really help you emotionally orientate yourself to looking for high probability setups and also understanding bar by bar some of the market dynamics. Now these dotted lines that are on here are just merely period separators for the first day of the month, and we'll do one later with the days with the Monday to Friday cycle as well. But let's just say, for example, we'll start off over here, and we're just going to look at bar by bar where traders potentially could be trapped into trades. So for example, in this particular case, first bar that we talk about, the first two bars of the month and the initial balance. So in this particular case, if we went bar by bar, the second day of the month, we know that now traders that have been picked up short at the close of that second day, the traders who are short that market are now in negative equity. So they're in a losing position. And technically we could say that those traders are trapped. So their stops are most likely above this bar over here. So the next day the market trades, it takes in long traders. It's hard to see clearly, but you get the idea. That market took out the high of the previous day. It didn't move through, but now we know we've got bulls trapped and we've got bears trapped. But this is a high probability setup with a small bar where the market has broke out long and only mildly pulled back. And so breakout traders who may want to take a break of this small bar high with a stop below either this bar, or bulls who are here may take another position on this weak pullback to ride that through. Now again, if we follow this bar by bar, we go to the next day, we don't see anybody trapped. It's an inside bar, but then we get the big bear candle that prints, and now we know we've got bears trapped. And the most obvious place that market is definitely going to go to is to where these stops are placed on the bulls, where the bulls took this up. So bulls were long. If they're not going to break even now, they're at risk of getting stopped out. And again, breakout traders would short that candle and place their stop either up here or possibly 50% or wherever they saw fit. And theoretically, the market shouldn't really retrade past the open of that bull candle. So we now follow that down, and we just keep following that until we see evidence of traders being trapped. So obviously their bears are trapped there. We follow through. It's an inside bar. Now we know we've got short traders trapped there, but we've got a bias to the downside. And if we look at our initial balance now, we've possibly got the midpoint of the month. We might have a measured move about to set up, but we've got shorts triggered in here. Shorts triggered. Now we've got bulls triggered in on these breakout trades. Again, bears triggered in down here, stopped out if they were picked up on that bar. The next day, if they'd adjusted their stops, they were stopped out here. Then the market proceeds to fall. Okay, and again, we've got traders trapped here. So what we're looking for is evidence of where traders are trading the breakout. The market's obviously picked up their trade, but it's reversed. Their stop would be above that candle most likely, and now they've been stopped out. So we've got a bias to the downside. Again, opportunity to where traders can enter in at market depending on where their setup is or how their system generates. But again, you're looking for evidence of where traders are trapped. Now, people are going to say, well, how do you know, for example, to go short here? Well, again, the overall direction of bias of this trend is down. In this particular case, you're going, if you were buying the breakout traders were picked up here long, but they haven't been stopped out yet. So the next obvious place to go is the bottom of where those bull stops are. So you're always looking to position yourself in line to where there's the line of least resistance, and the market is going to be wanting to fill orders and seek liquidity. So we go in, we'll just apply that initial balance theory again with the first 2 bars of the month. So if we just draw our initial balance, we know there's been bias to the downside. But again, we're going to look for one of those 2 candles to possibly hold. Now, in a situation like this where the market has consolidated into that, we'll project that high and that low of the range of the consolidation across. So we get our big bull candle printing on the 4th day of the month, and breakout traders would have been trapped on the top of that bull candle. Perfect opportunity for bears to trade the break of that candle. Again, you're selling high in a downtrend with the idea that there's possibly going to be stops placed down here. Now the market makes a run down. Okay, doesn't quite seem to get all the way. We get a bull candle printing. Bulls are trapped here. If you were shorting that market and you'd be out of that minimum stopped out here, or savvy bulls would have stopped themselves out down here, or even possibly exited on the low of that bar because we started to see that consolidating down into the body of that candle, consolidating just outside of the range of the previous day. So all we're doing here is we're going bar by bar. We're looking to see where the market is trapping traders, and there's a high probability that it's going to seek to fill the orders on the other side of that candle. Oftentimes the dojis, if you're trading on a doji, you want to be trading with trend. If it's a doji and it's counter trend, you want to be looking to see who's trapped. So in this particular case, the market's breaking out. We know that there's bulls trapped in to the market. So again, some simple lines of support and resistance, and we're looking to see who's trapped. Now we know after this doji bull candle that people who shorted that market are now trapped. The bear pulled back inside a range of the bull candle. On this particular day, you may want to go long at market. There's breakout traders who could have got in long there. And again, whenever the market proceeds to make new highs, even if it pulls back in, once the market makes a new high, you want to be looking to either be getting to break even or taking profit. And the reason why that is that when the market breaks to new highs or new lows, that's the most vulnerable place for that to fail. So again, in this particular case, you wouldn't have been stopped out unless you had already moved to break even, or if you'd captured profits up here. So again, when we see this market with the bear candle pull back, okay, we know that bears are short. They've been trapped down here somewhere. The market, if you were to trade and go long above that bear candle, the most obvious place it's going to go is it's going to seek stops above the previous bull high. And again, we see the market break out strongly. So look for trap traders. Look for evidence of where one side has been stopped out. Look for where the obvious stops are being placed, because once those orders are hit, the market will most likely accelerate to fill orders above or below. Go bar by bar. Look for trap traders. Remember the initial balance principle. You're looking at the first 2 candles of the month for a potential buying or selling area. If the market's already been trending up, look for an area where the market is trapping people and it's going to seek volume on the other side. Keep it simple. Manage your position, manage the downside, stick to your risk management rules, print off a bunch of these charts, go bar by bar, start looking to see where traders are being trapped. On these monthly ATR moves, you can see where if you're getting in on one of these trades, your risk should only ever be 1 candle, okay? And if you're timing these properly, the risk reward should be anywhere at least 1 to 1, maybe 2, 3, 4, 5 to 1. So in some of these situations, again, you can see here, market breaks out, gives traders a couple of opportunities to enter into these trades, and again, you're looking at maybe 2, 3 to 1 in terms of risk reward. Hope you got some value out of this today, traders. Print off a whole bunch of blank charts, start going bar by bar, look for seeing who's trapped, and then experiment with how you would position your limit orders to be picked up by the market in the direction of the move, and then how you would manage that trade and exit it. Thanks, traders, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.